And one thing that kind of builds up over time, this is like another one-way train. So the U.S. as the world reserve currency is running these structural trade deficits, which over time means more and more countries accumulate reserves relative to their external debts. And so our ability to crush areas gets kind of weaker over time. So back then we had basically all the cards. We could just crush other countries, and that wouldn't ricochet back to us very quickly. And then in the 90s, we could do it again, but a little bit less powerfully. And now a lot of these countries have built up such big reserves that they're more resilient. So, for example, Brazil and China and India, for example, a lot of these countries are able to kind of hold on in the face of a strong dollar better than they could have, in the prior strong dollar cycle of like the late 90s or the one before that in the 80s. Now, there's still individual countries that get caught out. So, for example, Turkey and Argentina and Egypt and a bunch of countries in Africa, some of these countries that are not even classified as emerging, some of them were classified as frontier, whereas ones like Turkey are obviously, more developed. But either way, those are the ones that have run into issues in this cycle. But that's a smaller percentage of global GDP than if you manage to, say, catch China or catch Brazil again.
In the 1940s and 50s, Social Security benefits aligned closely with life expectancy, meaning fewer years spent drawing benefits. Today, Americans live much longer, putting significant strain on Social Security and concentrating wealth among older demographics. Additionally, the US spends 3 times more per capita on healthcare compared to Japan, where efficient spending allows them to manage deficits more effectively. This contrast highlights a critical issue. While Japan maintains lower wealth concentration and fiscal stability, the US faces increasing polarization and wealth concentration. As fiscal dominance continues, the US faces a looming crisis fueled by high healthcare and defense spending, which diverts resources away from younger demographics. This scenario, coupled with structural trade deficits, weakens the US's ability to exert economic pressure globally. By 2025, the Federal Reserve may need to increase its balance sheet, potentially leading to a weaker dollar.
In the 40s and 50s, a lot of the deficits was flowing toward the younger side. And for example, Social Security, the age of receiving that was not that different from the average life expectancy. And so the amount of time that the average person would spend in that state of kind of receiving those benefits was lower. Obviously, there's big variance. Whereas now, on average, life expectancy is a lot higher than Social Security. And there's that big chunk of demographics that moved into it. And so in the 40s and 50s, you had declining wealth concentration. There's also, they're very high, they did extremely high tax rates in that period. And so a lot of the bondholders were wealthy. They were getting devalued. A lot of the wealthy people were paying very high taxes. Yeah, and most people would not be paying 90%, but yeah, on that marginal high dollar, yeah, they were very high tax rates. And so that's kind of what they went through at that time. So it was a really draconian for people who held bonds, held cash, or made a lot of money, and that it was beneficial for anything on the receiving side of some of what was happening. Whereas in the current time, as you showed from that chart of where our money goes, a lot of it's going to Social Security, a lot of it's going to healthcare, and a lot of it's going to the defense, the military industrial complex, right? So that's generally going to older, wealthier demographics. And it's not really going to the younger side. And so that kind of fuels ongoing polarization. It fuels more and more kind of wealth concentration. Whereas in Japan, you have somewhat of a different case. They have lower wealth concentration because if you look at where their deficits are going, it's not really going to defense. It's not really going abroad. It's mostly going to things like healthcare and things like that. And they pay something like a third per capita on healthcare of what we do in the United States, even though on average they're older. So basically that money is kind of less kind of thrown everywhere and less kind of thrown in ways that are kind of politically unpopular. And so that's another reason why they're able to stay in a state of fiscal dominance for longer, is because they're kind of doing it almost as effective as they could, given like all the demographics issues they face. They have a lot of kind of tailwinds that help them. Whereas in the U.S., we're paying 3 times as much for healthcare. Our military spending relative to GDP is bigger, and a lot of it's more foreign. And so those are things not really going back to people in the same way. So it really depends on those details. So that, I think, partially depends on what stage of fiscal dominance that we're in. So as you point out, mostly it's the developed world that's in fiscal dominance to varying degrees now. When that starts to become more and more apparent and gets more and more extreme, that probably starts to benefit those other countries. But at the current time, it's not really benefiting them yet because the market still kind of fully thinks that the Fed has this under control. And so, for example, right now the dollar index is fairly strong, and that hurts countries that have a lot of dollar debt, like Latin America, for example. They're in an environment where they have a decent amount of dollar debt, and so when the dollar strengthens, their liabilities are getting harder relative to the cash flows that they're earning. And so you generally see depression-like characteristics. They're like real GDP in dollar terms starts going like sideways for like.
So it's like when Volcker was squeezing sort of like the U.S. And like increasing interest rates, he was absolutely like devastating emerging economies around the world.
Yeah, that's kind of the dark side of what he did, is that so he did slow down loan creation and these other factors, but also by spiking the dollar, he basically put Latin America into a depression. If you look at their oil consumption, it like flatlined for like a decade. And so that alleviated some of the supply issues for the United States. So basically, over time, they try to push that problem to someone else. And one thing that kind of builds up over time, this is like another one-way train. So the U.S. as the world reserve currency is running these structural trade deficits, which over time means more and more countries accumulate reserves relative to their external debts. And so our ability to crush areas gets kind of weaker over time. So back then we had basically all the cards. We could just crush other countries, and that wouldn't ricochet back to us very quickly. And then in the 90s, we could do it again, but a little bit less powerfully. And now a lot of these countries have built up such big reserves that they're more resilient. So for example, Brazil and China and India, for example, a lot of these countries are able to kind of hold on in the face of a strong dollar better than they could have, in the prior strong dollar cycle of like the late 90s or the one before that in the 80s. Now there's still individual countries that get caught out. So for example, Turkey and Argentina and Egypt and a bunch of countries in Africa, some of these countries that are not even classified as emerging, some of them are classified as frontier, whereas ones like Turkey are obviously more developed. But either way, those are the ones that have run into issues in this cycle. But that's a smaller percentage of global GDP than if you manage to, say, catch China or catch Brazil again, for example. And so because these really big economic blocks they have more reserves relative to their external debts, and they're in a position to weather through this, it slows them down, it hardens them, it kind of pushes problems onto them, but they're able to kind of stand against it. I think where the next phase happens is, let's say in 2025 or give or take, a year or so, if the Federal Reserve has to go back to increasing its balance sheet, even when inflation is maybe still on the hotter side, that's when you could get a meaningfully weaker dollar index. And that could cause a boom in places like Latin America or elsewhere that have been pressured during this kind of strong dollar environment, but that have been able to get through it. So that's when you could start to see that rotation of who's harmed and who's benefiting. But basically, it's every country that's in fiscal dominance. It depends where their deficits are going, and then geopolitically, it depends on who has more debt than assets in terms of their foreign exposures.
Yeah. So, but like generally, fiscal dominance, is that going to, I know not right away, but like lead to a weaker dollar for and that could be good for many emerging countries around the world. But is that sort of the trend in the trajectory?
I think once you get to that switchover point. So right now, somewhat counterintuitively, fiscal dominance has benefited the U.S. If you can run a combination of loose fiscal policy but tight monetary policy, that actually can strengthen a currency temporarily. That happened in the 80s, and that happened kind of in recent years. But when eventually that kind of runs its course, because you can't run that combination together for very long, eventually, we're already seeing, for example, the Federal Reserve is tapering their rate of balance sheet reduction. And the next step is probably to stop balance sheet reduction, and the step after that would be going back to some degree of mild balance sheet expansion. So in the past 2 years, where they could run fairly tight monetary policy with that loose fiscal policy, that's actually, it's strong dollar. It's negative for emerging markets. It kind of puts pressure on them. But when they kind of fully relent and the balance sheet starts going back up structurally, and people get increasingly aware that it's going up because of the fiscal deficits that they're kind of forced to monetize, that's when I think you could see a bottoming of the economies of Latin America and certain other regions.
Thanks for tuning in to today's discussion. Let's quickly recap the key points. We explored how longer life expectancy today is straining social security and concentrating wealth among older demographics. The US spends 3 times more per capita on healthcare compared to Japan, affecting our ability to manage deficits efficiently. The ongoing fiscal dominance in the US, driven by high healthcare and defense spending, is diverting resources from younger generations and increasing economic polarization. Emerging markets, now more resilient with larger reserves, could benefit from a potential weaker dollar by 2025, triggered by changes in Federal Reserve policies. If you found today's insights valuable, please give this video a thumbs up, share it with your friends, and subscribe to our channel for more in-depth discussions on critical economic issues. We'd love to hear your thoughts, so feel free to leave a comment below.